The best strategy for gold investors. Let's explore gold futures, as well as usage in an investment portfolio. Key takeaways: investing in and trading gold can be rewarding, and gold futures are an easy way to get started. Gold can be traded like a commodity, along with the other precious metals, where supply and demand considerations come into play. At the same time, it also functions as a currency, lending it to several different trading strategies found in forex markets. Most of the gold supplied to the market each year goes into manufactured products, with the remainder going to private investors and monetary reserves. Gold has a long history of use as currency or as a reserve backing for other forms of money. However, the gold standard is not currently used by any government, having been replaced completely by fiat currency. Investing in the financial markets demands the ability to change perspectives over time. If gold bars or Krugerrands, a 1-ounce South African gold coin, are purchased, then the physical possession of the gold remains the same regardless of the market price. Diversification of a portfolio means varying the asset classes. The value goes up or down, changes with the market, and the paper certificates can be worth nothing. The value of gold goes up and down and changes with the market but is never worth nothing. You may not profit from owning gold, but at least you will own a desirable tangible asset, whatever the monetary value. Is the intent to increase wealth or to have gold, which can at any time be traded for food or shelter? Gold held for an emergency is different than buying a futures contract or stock in a gold mining company. Let's compare buying gold Krugerrands to buying another physical asset, such as a home. Whether the price of gold Krugerrands goes up or down, you still hold them and they are part of your estate. Now let's look at buying shares of an exchange-traded fund, ETF, like the SPDR Gold Shares GLD, NYSE, GLD, Figure 2. If the price goes down from where you buy it, you have lost money and the paper may even become worthless if market selling action greatly overshadows buying action. There are two ways to invest in the gold market, either buying the physical commodity gold or buying a futures contract. Buying the physical commodity gold is to have ownership. Buying a futures contract or stock is speculation, where you do not own any gold but can make a profit. A gold futures contract is a legally binding agreement for the delivery of gold in the future at an agreed-upon price. The contracts are standardized by a futures exchange as to the quantity, quality, time, and place of delivery. Stocks of gold miners or related companies offer shares, but this does not represent any form of gold ownership. The gold bullion market is international. The premise is that if there is an economic collapse and paper money becomes obsolete, gold will retain value. Currency is any form of money of any country, and money is anything that can be exchanged or bartered for something else, making gold the ultimate form of money during an economic recession. If the desire is to have a commodity as an alternative medium of exchange, buy gold bullion. Foreign currencies do not replace gold because no country is on the gold standard. A purchase may require more or less gold, depending on demand, but gold is usually acceptable. Gold stocks are not redeemed for gold. Gold futures contracts are seldom redeemed for gold.